Today's video is about a stock that I feel is a little bit undervalued. Alibaba stock has hit lows we haven't seen since 2017. I'm going to talk about 3 headwinds that slapped the stock around in 2021, and in the meantime, I'll build out a forecast for what we can expect for stock price for the next 10 years. Make sure you watch until the end because I'll give you some forecasted stock prices and outline some risks. Is it all over for Baba, or is this a buying opportunity? I'm a holder of the stock, so I'm excited to find out, so let's just get into it. If you don't know already, Alibaba is a Chinese company headed by Jack Ma. Its core business is e-commerce, and it does a few other things as well, but most notable is owning Ant Group, China's largest digital payment service. Last year was really rough for Alibaba. While the stock suffers from uncertainty every time China and US relations are called into question, it was dealt an extra blow last summer when the CCP decided it would start interfering with major businesses in its country to be able to more equally distribute wealth. Xi Jinping said that the current regulations have favored capitalism and have led to a huge gap between the rich and the poor. Part of the correction would be to redistribute the wealth from major companies in the country in order to start growing the middle class of China. But she has also said China will not sacrifice the rich to get this done. Now, the regulatory policy is not the focus of this video, but what does that mean for Alibaba? How much are they going to pay? Well, $15.5 billion to be exact, over the next 5 years. And correcting this issue isn't going to be done in 5 years, so I'm willing to bet that the CCP will be continuing this in the future. So let's look at what this means for a forecast. Okay, so let's look at how this pledge would affect Baba's growth from a cash flow perspective. Here I have the cash flow trends for the last 10 years. Quick note that the fiscal year for Baba ends in March, so when you see March 2021, that is 9 months of 2020 and 3 months of 2021. So we're missing some info, and we just got the Q3 earnings, but we'll talk about these a little bit later. Now, CFO has grown from 2 billion to 35 billion in 10 years, which is amazing. But where would that 3 billion a year come from? Keep in mind that if we pretended it was a debt, we wouldn't even be discussing 3 billion because compared to the CFO, it's very small. But most likely we will see this 3 billion as a reduction in operating cash flow. That annual $3 billion donation would make up 12.5% of the cash flow in this last 12 months, but the cash flow is forecasted to grow over the coming years and, for example, will make up 8% of the forecasted cash flow in 2024. So not only is this $3 billion affordable by Alibaba, but becomes even more affordable as time goes on. So let's leave the growth forecast alone for a second and let's talk about another rumor, which was delisting. There were rumors of Alibaba being delisted because of the Chinese government forbidding companies to raise foreign capital, which in itself doesn't really make sense to me. First, delisting is technically when a stock is doing so bad it risks getting removed from the stock exchange it's on, but can still be traded over the counter in the market. Remember when we first heard Tesla was going to join the S&P 500 and how that news lifted the stock price? It's because being listed on a stock exchange allows many other fund managers to buy into the stock, so being delisted then has the opposite effect. But you can still trade the stock. What should have been said was that Baba stock risks being unlisted, which is different. Baba actually exists as a shell company of the original Chinese stock. This is a way that Chinese companies have brought in US investment dollars. So should the CCP bring an end to this, then there would have been a risk of Baba being removed entirely. What happens then? Well, nobody knows, and that uncertainty is what kicked down the stock price. But China has stated that it doesn't intend to outlaw VIEs that already exist, so all of this hype could be for nothing, unless China changes its mind. Okay, so now let's move to the market multiple method and do some quick checks to make sure the company is making money. Revenue is showing great growth, $5 to $109 billion over 10 years. For extra info, Q1 of this fiscal year revenue went up 34%, 29% in Q2, and 10% in Q3 when you compare quarter to quarter. Alibaba does expect the revenue to only go up 20 to 23% for the fiscal year, so what we are seeing is some slowing growth. Still healthy numbers in my opinion though. Now EBITDA grew from $2 to $24 billion, which is crazy. Q1 was down 5%, Q2 down 27%, and Q3 was down 27% compared to the same quarters in the previous year. Now that could be partially explained because it would be hard to outpace the COVID years when everybody was at home. And also keep in mind that the drop in operating income can also be attributed to unrealized losses of its stock. But again, underneath that, we should expect some slowing growth. Debt has steadily increased along with earnings, but we do have a lot of excess cash sitting here in 2021, so I'm not too worried about that. One thing I will point out is the slowing EV to EBITDA ratio here, because we are going to use that in our growth forecast later. But first, let's talk about one more headwind. Another blow dealt to Baba in late 2021 is missing analyst estimates, which is my favorite. The company was still making money, but since it missed the high estimates of 30+% growth, it caused many to jump ship. I guess 20 to 23% growth forecasted by the company isn't enough, but reactions to analysts can always present us value investors with some opportunities. Okay, so what about about my forecasts. I want to take all of this into consideration. 3 billion a year, delisting, and missing analyst estimates don't really scare me. What does trouble me, however, is the fact that the Chinese government will be a direct competitor in a sector that Alibaba is seeing a lot of growth in, cloud computing. The CCCP has been cracking down on tech companies to be able to access customer information, so it makes sense that the government is setting up cloud computing infrastructure of its own. What I don't like is that Baba has seen 30% growth in this area of its business year over year, but if the government wants to win, I really don't see how they wouldn't just interfere again to make sure that they do. That's the real worry and what I'm going to take into account in my forecast. How will I model this? Well, for the DCF method, if I took the 3 billion out of the 2021 fiscal year, it would actually change my FCFE per share by over $1. So I'll take this value and trim it a bit more and really drag down my growth factor. FCFE per share averaged 22% in the last 5 years. I'm giving it next to 0 for the next year and then 8% and trimming it down. It's basically dragging a boat anchor along with growth right now. When I do that, I get a 10-year stock price forecast of $500 a share for the DCF method. Showing slowing growth, I'm going to apply the same profile to the market multiple method. Even though historically the stock has traded at a multiple of over 30, I'm going to use this downward trend because it's showing signs of slowing growth, and I'm going to use 20. If I apply the same growth forecast of decreasing single digits to that, I get a 10-year stock price of $308. So where does that leave us? At today's prices, even at low growth values, this yields an IRR of 26%. Even at 150 bucks, it's an IRR of 20, which is above the long-term return of the S&P. Now remember, that is because there were some impressive historical numbers in this model, so don't get me wrong. Baba has its challenges, mainly the CCCP, which is basically like trying to run your business on an episode of Wipeout. The obstacles are everywhere, but I don't think it warrants the 60% price drop that we've seen recently. Keep in mind that the EPS only went down 21.5%. So normally I would feel very comfortable putting a lot of money into this stock, but because the Chinese government has demonstrated it will meddle in business, it adds some uncertainty here that will likely cause me to trim back how much of my portfolio I leave as Baba. There's a higher risk factor than normal because we don't have the confidence that the government will leave this company alone, especially when it's trying to put its own cloud computing business together and be in direct competition with Baba. For sure, you can expect if the Q4 numbers are good that the price will climb, and if they miss estimates or Baba trims their forecast again, prices can get even lower. Now, if you'd like to see a video where I explain these charts in more depth, check out this one about Facebook or Meta stock.